Hi guys, this video is for Friday, September 5th, 2014 with Chapter 3. Something to cover before we start getting into the chapter. You each need to look at your test from Chapter 2, and if you want to retake the test, you are more than welcome to. It needs to be completed by September 12th, which is next Friday, and it needs to be done on your own time. Class time will not be used to redo that. I would highly suggest each of you take a peek and decide what you would like to do. Other than that, we're going to start getting into Chapter 3 today. Chapter 3 is journalizing transactions. We're starting to get into more of the nuts and bolts of accounting now. So Chapter 3 includes 4 different sections: journals, source documents, and recording entries in a journal. That is Section 1, what we're going to go through today. Journalizing, buying insurance, buying on account, and paying on account is Section 2. Section 3 consists of journalizing transactions that affect the owner's equity, which would be your revenues and expenses, and receiving cash on account. And the final one is proving and ruling a journal. So today we're just going to look at Section 1, journals, source documents, and recording entries in a journal. After we're done with this, you'll be able to define your terms, which there are 11 for this chapter. Identify concepts, there's only one new one this chapter, and then actually do the recording of the transactions. As you can see, there's 11 terms on here. If you don't get the definition, go ahead, pause the video, replay the sections that you need. So our first one is a journal. This is a form that's used, and you record the transactions in chronological order with that. Next is journalizing, and this is the process of recording the transactions. Your third one is entry. This is just the information for each transaction. That's just what it's called. General journal. This has 2 columns, and it is a specific type of journal, and there's all kinds of entries that can go into it. Double entry accounting. This is actually what we have been doing so far. We just haven't given it a name until now. And this, you record debits and credits of each transaction. So that's your double part. Debit is one part, credit is the other. Your source document is the paper that's obtained with information for a journal entry. This creates a paper trail. This will make more sense once we talk more about them. A check, you guys all know what a check is. You've seen one before. This just tells the bank that the business wants them to pay somebody else, and it is a form of a source document. An invoice, it's a form that describes the goods or services that were sold, how many, and the price. The sales invoice, which is a little more specific, is used as a source document, and that's for those sales on account. A receipt, you guys have all seen that. It's a form that a business gives to a person when the business receives cash. Then you have a memorandum. More than likely I will refer to it as memo throughout the class. This is just a form. There's a brief description written down about a transaction. And finally, our concept, objective evidence concept. And this just states a source document is prepared for each transaction. And this is what our paper trail is based off of. So moving right along, we have journals and journalizing. And you guys know we can put the transactions into the accounting equation, but that gets very messy, so we moved it to T accounts. As you guys know from last chapter, that can get very messy too. So we need to create more of a permanent record, something that looks a little nicer, easier to read, and that's what we use a journal for. And this is considered permanent. Anything that you would be writing in this general journal and for any other business activity is done in ink. That way it cannot be erased, and it's permanent. And we do have various journals that are available. However, the business looks at what they need and they pick one that best suits them. For all of our purposes right now, we are going to be using a general journal. It fits the transactions that we have, the number of transactions, and the nature of our business. And the word journal is actually a Latin word that is pronounced diurnalis, and it means daily. And to keep this in mind means transactions happen every day. If you think about going out to Corner Stop, they have transactions every single day that they are open. So as an accountant or a bookkeeper, you're going to record those transactions every single day. So what we have now in front of us, this is a sample of a general journal. There's not much variation of this, actually very, very little. It's called a general journal because you have your debit and your credit columns, and each column on here, date, account title, doc number, post ref, debit, and credit, are all used for each transaction. For our purposes right now, our post ref will not be used in this chapter. That happens next chapter. And there's 4 main things that these general journals help with. First one is accuracy. It splits your transactions into your debit and credit parts. You can easily verify if your debits equal your credits. And you can just compare your transaction. You could even total up each column and see if they equal. Also, when you do anything in a general journal, it is listed in chronological order. So if it happened on the 1st, it's listed on the 1st. The next day, everything that happens on the 2nd is listed on the 2nd. Everything goes in order, it's recorded in this one place, and it's very easy to locate the data. Going back to our vocabulary words, our double entry accounting, we know each transaction affects 2 accounts, just like what we have been doing. And everything has a debit, everything has a credit. And it also helps you ensure that debits equal credits. And finally, we have our source documents. And that's where you're going to use this doc number column. And this helps you create a paper trail. If you do something in the business, you have to account for it. Any transaction that happens has to be accounted for. If it's just like a quote that you're getting for a service that might be provided, that's not an actual thing that has happened, so it wouldn't be recorded. But you sold something, you create a receipt, maybe an invoice, whatever the case is, and you would put it down in your general journal. You have to have this paper trail. Now, if anybody questions your records, you can easily go in and show them, no, this is really what happened. And each transaction will have a source document. And this ties with your objective evidence concept. And there are 5 source documents that we're going to use: checks, sales invoices, receipts, memos, and calculator tapes. And we're going to go into that now. So as you can see in front of you, this is one style of check. This is one of the more popular ones for businesses because of how this check stub is listed out over here. And remember, this just tells the bank you need to go pay these people. So in this case, the bank needs to pay Port City Supply on behalf of Techno Consulting. This is used for all cash payments. All the checks are pre-numbered. You have the number on the check itself up here in the corner, and over here on the left on the check stub. You have to have each check accounted for. If you make a mistake, then you would write this in your write that in your general journal that it was a voided check. And we can abbreviate here. Checks are abbreviated with a C. Our next one that we have is a sales invoice. Once again, these are pre-numbered. Most of them are over here in the right-hand corner. And this describes the goods and services that were sold, how many of them, and then also the price. This is also known as a sales ticket or a sales slip, and these are always duplicated. So it's just like the papers that we send out for the yearbook ads. The top copy goes to the business, which would be the original copy. The carbon copy stays with us because that is our record. These are used for sales on account. So for example, this one, it was sold to Oakdale School. And you can see that in the corner where it says Oakdale School right up here. And just like checks, these are always pre-numbered. Each one must be accounted for. This one we would abbreviate as an S and then a number 1. We do have 3 other forms of source documents: a receipt, and you can see this is split into 2 parts similar to your checks. The left side is kept by the business, the right side goes to the customer or whoever you receive the money from. So this acknowledges that you did receive cash from transactions, something other than sales. So with the sample you see here, this was an investment from the owner. It might be a payment on account. Once again, just like everything else, these are pre-numbered. You have your number on the stub, you have the number on the receipt itself. R is what you use for the abbreviation. We also have memos. These are just brief messages. They either describe a transaction or they provide more information, or it just serves as a source document if there's nothing else around. So in this case, you bought supplies on account from Supply Depot. You don't have an invoice, you did not receive an invoice from the other company, so you have to use a memo. Once again, you have to account for each memo. Each one is pre-numbered. M, as in monkey, is your abbreviation. And finally, we use calculator tapes. You can think of these as a register tape also. This is when cash is paid for sales. And so if you think about Corner Stop, they run a lot of transactions through. So at the end of the day, they will figure out how much total they did in cash sales, and they'll run one receipt for it. So this is a source document that they would use. This helps save time and space in the accounting process. Could you imagine writing down 50 different sales transactions? Think about how many Corner Stop would do. It would take too much time, too much energy, too much space to keep those records. With these, they are not pre-numbered. Whoever runs the tape would have an idea of what number you are on. We use a T as the abbreviation, and the person who ran it would number it. So in this case, it is T12. And then you put down the date that it was ran. For here, it was August 12th. Finally, or not quite finally, when we look at entries themselves, each one has 4 parts: the date, the debit, the credit, and the source document. Things that we just saw on the general journal a couple slides back. Each transaction is analyzed, and then you split those into those parts. Debits must always equal credits. If an account is credited, just like Chapter 2, you're going to list it second. However, you're going to indent it. So we're going to take a look at it. Received cash from owner as investment. We know cash and capital are affected. So the first thing we're going to do is analyze the transaction. And you can see in the bottom right-hand corner of the slide the T accounts that are and how they're affected. So we're going to take our T account and we're going to apply it to what you see on the screen. So the first thing we're going to do, we're going to write the date. The year is always listed above the month. The next column over is the actual date. So like today is September 5th. So you would put 2014 September in the first column, then 5 in the second one. Cash is our debited account, so it's right up against the line. We had a receipt for it, so it's R1, and then the debit amount of $5,000. Then we have our credit account that is indented just a little bit. So we put in the capital, $5,000 for the credit part. Finally, your book says write down the source document last. However, if you want to do it as you go straight across, like I was just saying it, date, debit account, stock number, that's quite all right. It still works out the same. So paid cash for supplies. We know supplies is going to be debited because it's an asset and that balance is increasing. We know cash is credited. So since this happened in the same month, we do not need the month and the year over here in this column. We just need to put the date itself. We wrote in supplies and the amount for $275. Then we wrote down our cash with it indented a little bit, the amount, and our source document was a check. So we put in C1. And we got that information from the end of the transaction. Okay, that is all for today. There will be another video up going through the work together and on your own.